Greetings. Welcome back to the continuing lecture in Principles of Finance. Uh, this is Dr. Jeff Holm, and in our last class, we went over the example of a callable bond, valuing callable bond using this example of a company, right? Northern Timber Corporation, which issued 25-year bond, right? 5 years ago. And so I don't think we need to go over this example again. You can revisit the previous video and you can basically go over it by yourself. So we'll continue with the rest of the discussion. So now we understand some features of callable bond valuation, because if we have if you have a callable bond, the most salient feature of the callable bond is that it has a call protection period. And once call protection period expires, then it can be called anytime with the call premium. So see in this diagram, suppose you're in year 10, at the end of year 10, right? And this bond seems to have, it's actually not year 10, but 10th semester, end of 10th semester, right? And then it has it has 40 semesters left, right, until maturity, which is 20 years. And then if call protection, this doesn't really show call protection, what's the call protection period, right? But we can tell it is the call protection period, because if you, no matter how long the maturity is left, right, you can't use that maturity, because after the call protection, it can be called at any point, right? So the new maturity for, it's not really maturity, but the end of the call protection period is the timeline that you use. And it was issued 10 semesters ago, which means 5 years ago, and until the end of the call protection period there was another 10 semesters, which means 5 years, right? So the timeline, you use only the timeline left until the end of call protection. And at that point, you have to add in the call premium, right? So this is the diagram of the previous problem, right? Now, but then our next question is, so any callable bond can be called. If it is call bond, can it be called anytime? No, it's not necessarily true. Why? To call the bond, right? I think we went over this diagram before. Yeah, here. So in this diagram, right, this is a like a 10-year bond, right? Let's just assume that this is These are the years, not necessarily semesters. Uh, but think about it. The point is, um, so call protection ends. Call protection period ends at the end of year 6, and currently you're at the end of year 2, so you have only 4 years left, right? So it cannot be called until year 6, but after year 6 it can be called. But why would the company call the bond? Well, we already discussed it. There's only one reason. Um, the interest rate, the market interest rate has gone down, right? So they want to, then I told you calling bond is like, refinancing. You want to take advantage of the low interest rate now, so you borrow at a lower interest rate. So they will call only if the interest rate goes down. But if interest rate goes down around this time, like year 7, I mean, between year 6 and 7, yeah, it's worth making that call, right? It's worth calling the ball. But if you have 1 year left, right? Less time left until maturity. Um, the, is it good? I mean, is it beneficial to call the bond at that point? It's a simple. This is a simple analysis, cost benefit analysis, right? If you think about it, why? Because if you call, then you have to pay 1 more year expense as call premium. So suppose your bond has 10% coupon rate, right? And the interest rate went down to average, market interest rate went down drastically. Let's say to something like 5%. Suppose then your bond rating is, your company's credit rating is just about average, right? Then that means you can sell new bonds at the prevailing market rate, which is 5%. Now think about it. There should be so with 1 year left, right? Let's say if you call the bond, what do you have to do? You will have to pay 1 more interest of 10%, right? But then if you call the bond and refinance it at this point, right? From year 9, you may be you're starting new. You're starting anew with the a 5% coupon bond. That means this year, for 1 year, you'll pay 5% interest, right, for the new bonds that you sold. But then to the old bond holders, you have to pay call premium of 10%. So what's the point then? You're not saving, right? There's no saving. You're not making any. You're not saving anything on interest, right? You're actually paying. Um, you're paying 5% here for the new bondholders and paying 10% to the old bondholders. So it's actually like 15%. You're paying 15% in year 9, right? I mean, which is the actually year 10, because this is the end of year 9 and beginning of year 10. So actually there's no interest savings. Actually, you're just paying 5% more interest, right? So it would make sense, right, if whole at least at the end of year 7, because you'll be saving 5% at least, because you're going to be paying 5, right? 5%, right? But if you didn't, but you're just paying, 10% more, right? If you, in other words, as a call premium, you're paying 10%, right? But you'll be paying 5% every year for, for the next 3 years. And of course, only 3 years is only the first 3 years of the new bond, right? So at least, there is, a 5% interest saving. But from at the end of year 8, with 2 years left, there is no interest saving at all. Makes sense? Because you're going to be paying 5%, 5%, that's 10% already, right, for 2 years. But, you pay 10% to the old bondholders, right, for call premium. So the complete, you just, the 10% interest saving from the next 2 years is completely wiped by the 10% called premium, right, to the old bondholders, right? So that's the that makes it more unlikely as time approaches maturity, right? Coal becomes more and more unlikely as you reach the maturity, right? So that explains, one thing that is, crucial in refunding decision. It says refunding. It's this. I told you in bond refinancing is called refunding, but it's the same. Same idea, basically. Now, but so whether there is interest saving or not, is that the only factor? Well, that's one factor, and that's the major factor. Another factor is flotation cost. Well, and what's flotation cost? It's the cost incurred in issuing new bonds, which includes brokerage fees, administrative expenses, printing of the new bonds, etc., etc. Floating means, usually when you are making an announcement for sale of new bonds or new stocks, that's called flotation. You're floating the bonds, you're floating the stocks issues. Also, you're floating a tender announcement. So a tender is on the dollar. If you look at on the face of the dollar bill, you would see this is a legal tender. What does that mean? It's also you're saying I'm tending my resignation. What does that mean? You are handing out, you're issuing, or you're handing out the resignation or submitting a resignation, right? But a tender is like an auction, right? But it's like a reverse auction. What that means is in an auction, you are usually bidding for a product, right? A merchandise, right? Tender is usually for a project, right? A construction project. For example, if a state of New York is, building, aqueduct or, waterways, to draw water from the clean water source from upstate. And they have, water tunnel or aqueduct, already. That was even, portrayed in the old, what was that? The Lethal Weapon. No, Lethal Weapon or some kind of movie like that, right? So anyway, infrastructure project, right? A New York State is, floating an infrastructure project. I mean, I don't know how else it can be phrased, but that's how it is phrased. They are New York State is planning and going to launch a infrastructure project. So then, what do? They will have to uh, float an announcement about that project, right? Floating an announcement means, in a news media or of New York State official uh, procurement website, right? Government is procuring, things that the government needs, right? But this is not a merchandise, it's a project, it's a construction project, right? Infrastructure project. So what do? They float a tender. Tender means, that's a public bidding, right? So obviously, then the construction companies, engineering companies, they will bid in the project, right? That a bid in the uh, tender for the project to win the project, right? So, so I don't, I don't know why I'm explaining what flotation means. You got to look it up. I mean, I have to, uh, well, because, but sometimes I feel the need to do this because the majority, a lot of students in this class are international students, or even if um, uh, you're not an international student. Uh, but uh, so for international students, of course, this type of terminology is totally new. I mean, have never been exposed to this type of terminology. Or even if you're a American-born student, right? Uh, some of some of you or even the majority of you were, never been exposed to this type of terminology. You don't, a lot of things that are used in the official um, domain, official realm, a business professional realm. I mean, these things are only learned through reading, right? Reading of a very vast amount of documents, variety, whole variety and vast amount, variety of documents, legal documents especially. But if you're just, and even if you're, U.S. born and raised, thinking, believing you're an American, but you never read those things. You just, surf the web, just, play games online, uh, barely read anything, right? Just read at best, at most, Facebook. I can tell because, I can tell, when you write email to me, it's just the way you write it is just like, texting. No period at the end of the, no punctuation, whatever. No capitalization of the beginning of this sentence. I mean, the very basic things that you should have learned through, K through 12, right? Where is it? It's all missing. And hardly anyone writes anything logically. In a very compact, logical, concise, and terse manner. Almost everybody is writing almost like, just like, they are texting. This is the reality, right? This is the reality of the public education, K through 12. Sometimes I find some people really, good in writing. But then even if you're good in writing, and I believe those people have been either very well educated, smart, uh, or uh, probably private, went to private school, which is more rigorous in enforcing those things. But public schools never enforce anything. You have never been enforced to be held up to accountability, and that results in this ridiculous total failure of literacy and numeracy. Not just that, a complete failure in logical thinking, analytical reasoning, critical thinking, deductive reasoning. None of these is present in your mindset. It's deplorable, but what can I say? That is the reality. You guys never read anything, legal or anything official. At least read New York Times. Please. Opinion page, please. At least opinions. New York Times opinions. Right? Not just the reporting of the facts, but opinions. That's how you push your envelope, intellectual envelope. And try to write like that. Not just like texting. But anyway, back to flotation, right? Floating a tender, floating new stocks, new bonds. Why? What it means, right? So think about it. Making a flotation is not for free. Making an announcement in print media, like major newspapers, would cost money, right? And so also brokerage fees, when you sell new stocks or new bonds, brokerage fees, administrative expenses, printing of new bonds, all all these things are called flotation cost. And so think about it. Interest savings from issuing new bonds, selling new bonds must outweigh, right? Must be greater than call premium and flotation cost. If it's not the case, then you don't call the bonds. Okay. Now, also some bonds have obscure call features. This is what you must look out for. Some bonds do not clearly state, explicitly state that it is a callable bond, but rather it is, buried in the fine print, right? That people generally don't read, right? Fine print. And one of them is sinking fund provision. What is a sinking fund? Sinking fund is another name for future value of annuity. Future value of annuity. So if it is a future value of annuity, why does it come into play here? Well, first of all, it has two. Future value of annuity has good side and bad side. Okay, what's the good side? I mean, first of all, think about it. It enhances the it improves the credibility, credit rating of the company. For example, a company has like double B credit rating. Double B is right below triple B, and remember triple B is uh, the minimum of the investment grade. So let's doesn't matter. Okay, so here's the there are three rating systems actually. There are two rating agencies which are most well known, and these are U.S. American credit rating agencies: S&P, Standard and Poor's, and Moody's, right? And the third one is British. A third one is IBC Fitch, right? Which is a British, rating agency, credit rating agency. And I believe it used to be, I believe it is British, right? I thought in the past it was somehow Swiss, but for I think British is correct, right? But it can be owned, by uh, uh, British majority shareholder, based, and then the agency, the company is based in probably Switzerland. But anyway, as you see, I've been telling you, it doesn't really need to uh, re, recapped over and over, but it goes without saying, AAA is the best. Double A is next. Single A, triple B, right? And triple B and above are called investment grade. Okay. Uh, so, although Moody's uses a slightly different system, but if it is B double A, what does that mean? That's triple B, right? B A double B. Now, triple B and above, right? And double B are called generally fallen angels, right? Double B, single B, generally called fallen angels. The names, these names, figurative names, figurative names are really uh, I don't know, maybe an idea to make something that may otherwise look very boring or just brain frying. Fallen Angels gives it some literary touch to that. Well, the coronavirus, uh, the adverse impact of coronavirus to the economy. They call it black swan, black swan, like shadow of death, black swan. All these, some people were being very, I should say, had sense of humor or uh, also, yeah, in the bond market, there are bonds called that are called, uh, foreign bonds called, I mean, bonds denominated in foreign currency, right? Sold in the domestic market, called such as samurai bonds or bulldog bonds. Bulldog bonds are obvious. Samurai bonds are the bonds uh, uh, sold in the U.S. market, but denominated in Japanese yen. bulldog bonds, bonds, sold in the U.S. market, but denominated in British pound. All these names, the nicknames. Uh, it's it makes it gives some, I would say, sense of humor to, or to something otherwise that would be very dry, cut, right? But anyway, so suppose the company's credit rating is double B, right? A fallen angel, right? And if that's, we understand very well, it's going to be difficult to us for such a to sell bonds. So what do? Um, as they sell bond, they start a sinking fund, meaning they will set up an account for future value of annuity. So if they are selling $10 million worth of bonds, then they set up a sinking fund for $10 million. It may be that the idea is it may be very difficult. It may be difficult to even for a very profitable company, right? Just coughing up, let's say 10 years later, just coughing up $10 million won't be easy, right? From their own out of their own pocket, it won't be easy. But if they set up a sinking fund, monthly and every month for 10 years, every month they put in like $50,000, every month, and over 10 years, which will be 120 months, it should take probably more than $50,000, but whatever the monthly deposit will be, whatever it may be, it would be easier to um, uh, accumulate, right? To build up, $10 million through future value of annuity, and then they will have money ready at maturity to pay off the existing bondholders, right, to retire. So this gives. What does this do? This improves the credit rating or the credibility, credit worthiness of this company, right? The credit worthiness of this bond. So it improves, and so the bond will sell. Uh, the bonds will have better chance of uh, selling, right? So you might say, well, that must be a good thing. Why is it bad? It could be a bad thing. The downside is some callable bonds use sinking fund instead of clearly stating that this bond is callable. Then um, they use like structured sinking fund. For example, 3 year, they set up 3 year sinking fund, and then 6 year sinking fund, 10 year sinking fund. Uh, so if it is 3 year sinking fund, what does that mean? They are going to retire some amount in 3 years, right? And they will get the money ready for that, right, through the sinking fund. And then another portion of the bond in 6 years and in 10 years, 9 years, So in other words, this is another way of indirectly insinuating that this is a callable bond, right? Uh, it requires the issuer to call in and retire a fixed percentage of the issue each year. And if this is the case, usually there's no call premium. And which serial number? I mean, if you if you issue, $10 million worth of bonds, right? And so that means there will be at least 10,000 bonds because the face value is uh, 1,000, right? At least about 10,000. There must be a serial number, right? Uh, and so which serial number gets called is determined by lottery, right? So just because your serial number is, like towards towards the end, like 9,000, 900 something, uh, you can't be, you can't rest assured that you can't that it won't get cold until the end. Uh, it can't be cold. So now, this brings us back to the very fundamental idea concept that we already know. I, from the day one, I've been telling you from ROI, what did I say? There is an inverse relationship between the price of the bond and the interest rate. Remember that, right? If bond price goes up, that means interest rate is going down, right? Now, I'm not going to go back to that, because it's just taking up a lot of our time, and uh, we cannot be uh, caught up with the background explanation. Um, you got to go revisit the lecture notes of ROI, and this is, this has been proven, empirically. This is the evidence, right? Uh, Empirical evidence. No. This is the record of bond price and interest rate from 1980 through 2010. 1980 through 2010 is 3 decades, right? And over 3 decades, look, this blue line represents bond price, and this gray dotted line represents interest rate. And think about it. Interest rate is in percentage, bond price is in thousands of dollars, right? Hundreds, thousands of dollars, right? And $1,000, right? So they cannot be put on the same. They cannot be put on the same graph because their measurement is in different units. But yes, they can be put on the same plane, if we use 2 different axes, right? You see, the left vertical axis is dollar price, right? So to check the bond price level, you'll have to look at the left axis. The right axis is percentage. That means, right axis is to, read the interest rate. You got to look at the right axis. So over the 30-year period, when interest rate was very high, interest rate was near even 15%. And I've been telling you, back in like 2000, in 83, 84, 85, 82, those years, interest rate was very high, almost 15%. And look, 1981, that was 15%. 82 through 80, 4, still, 82, 83, still about, 14%. Very high interest rate, right? And where was the bond price at the time? Bond price was, right, $800, which is, discount bond, right? And when was the bond at $1,000? When, 1980, when interest rate was like 12%. Still, that was very high interest rate by historical standards. And then you see, as interest rates drop, the bond prices increased, right? Bond price went up. And when interest rate was down here, around where? 5%, 4%, where is the bond price? 1,600, right? Right? And 1,500. Interest rate was about 3.5%. But then you would also notice that in around 2008, 2009, 2010, interest rate is close to zero. And you know why? What happened in 2008, 9, 10? financial crisis. And during the financial crisis, Federal Reserve had to lower the interest rate to boost the economy, right? To stimulate the economy and stimulate the recovery. And just the same thing same thing is going on these days with this pandemic, coronavirus pandemic. The economy is has entered recession. On March, 19th, market lost almost, 40%, 30, I would say, not 40%, about at least close to 30%. Although stock market got a little better now, but we're not out of the woods. Still, the consensus among the economists is that the economy will barely make a turnaround in the third quarter. And the stock market is always irrational in the short run, right? Crazy, so it overreacted, and then it also overreacts again. It looks like it is, bouncing back. So that's why I'm saying, stock market in the short run can be disconnected from the real economy, because even if the price, actually, if you look at the stock price, there's no reason the price should go up. But if there is no volume, think about it. Nobody is, you hunker down. During times like this, most investors hunker down. You sell your stocks, try to put it into safe assets like gold and bonds, right? Treasury especially, or preserve cash, hold cash. So actually, there is very little movement in the market. What that means is, very little volume. When there is very little trading volume, even a slight buy, because price is determined by transaction, demand and supply, right? Transaction. So even if normally there should be tens of millions of shares trading, for let's say company of X, right? Company X, for the stock of company X. But these days, the trading volume is only about 1,000 shares. But even 1,000 shares, that trading, if that's all the trading that's happening in the market, that determines the market price. Very small volume, right? Weak volume still. So there are still people buying. Even 1,000 shares, trading volume is 1,000 shares, 100 shares. These 100 shares buy pushes up the price, right? But the weak volume is certainly the sign that the market hasn't recovered, economy hasn't recovered, right? Anyway, you see that there is clearly an inverse relationship. And although it looks like, the interest rate is this low, then shouldn't the price be higher? No, this was, as I said, period of financial crisis, right? And during that period, hardly there's no positive outlook into the economy, so investors hunker down, right? So the price would fall, but look, even in those days, right? The bond price never fell below the par value, right? It was slightly above par value, right? So it's so obvious, right? But then we understand basically what this is the basically discussion we had a while ago, right? It's just a recap. So why there's a inverse relationship, right? So let's take a look at this example, because this example, and this explains what makes, premium bond and discount bond. And look, this is the notation I use the market for the market price, right? The premium bond is the bond that sells. This is the selling price of the bond, so the market price, greater than the face value, right? Discount bond is the bond that's selling below the face value, right? So now we can, because we understand the inverse relationship between the interest rate and the bond price, we can predict how the bond will behave. Bond price action will behave if we know how the interest rate will move. And we have pretty good idea about the interest rate move because the Federal Reserve always provides guidance, right? The Federal Reserve, after every FOMC meeting, and what is FOMC? Federal Open Market Committee, right? Remember that? So after, there are about 8 FOMC meetings throughout a year, right? So after every meeting, they have press conference, right? And through the press conference, they release the guidance. That means we're looking at the market and economy, and the economy is lacking liquidity. So for the next, for the next, for the time being, they wouldn't pinpoint for how long, but Federal Reserve, we are going to increase liquidity in the market. What does that mean? They are going to buy back bonds, right? And then by buying back bonds, what happens? The money will be injected into the economy because Federal Reserve will pay, right, for the bonds they buy back. And then as the if buy means, always buy is demand, right? So as the buy demand increases, the bond price will go up. So the interest rate will go down. The bond yield will go down. So interest rate will go down. So we can already, anticipate how interest rate will behave through the Federal Reserve. Guidance. And so if we know, then we can make our investment plan. Okay, so you anticipate long-term rates will fall from 6% to 5.5% during next year. If rate changes, right, that means change, right, what will be total return for 20-year 6.5% coupon bond? So this is the coupon rate. And what does this mean? This is the discount rate. Okay. They never say, use this as the discount rate, right? But why? This is that means, prevailing market interest rate, right? Long-term rates will fall from, when interest rates go down, that means what? You can tell the price will go up. So first, what will be the bond price today, right? At bond price at time t or time 0, and using the bond valuation formula, right? And this part is the present value of annuity. I mean, they put it this way, but I showed you last time in one of the previous lectures that this is basically, think about it. This is 1 over R minus 1 over R times 1 plus R raised to N, right? And this is payment, right? So payment over R, right? It's just another way of writing it. If they write it this way, then that makes it just look more complicated. So coupon payment will be $32.50. Why? 6.5. So annually $65. So semi-annually $32.50. And currently the discount rate is 6% annually, right? So semi-annually 3%. Makes sense? 20-year bond, 20 years left, right? So that's 40 semesters, right? So you got that. So we got 1,057. That's the price at time 0. And the price next year will be, right, price at time t plus 1. Now, coupon payment is the same because the coupon rate is, permanent until the maturity, right? Constant, right? Coupon cannot change. But the interest will be 5.5% next year. So half of this, 2.75%, right? 2.75. And then next year, how many years are left? This year you have 20 years left. Next year you'll have 19 years left. 19 years is 38 semesters, right? That's why it's 38 here. And it comes to $1,116.97. So you see there's going to be a capital gain, right? Between now and next year, there's going to be, if you buy this bond and sell it next year, right? There will be a capital gain. The capital gain will be 59, right? $59.18. But during the current year, you get interest of $60. I mean the coupon is 6.5, not 6%. So $65 during this year, right? So if you hold it this year and sell it next year, right? You'll have capital gains of 59, and the coupon payment of $65, right? So the total cash flow will be this plus this, right? And you, to buy this bond, you pay this. So this is your input or your initial investment. These two are cash flow from holding this bond. So if you divide that, adding these two, that comes to $124 divided by initial investment, right? What you paid. The total return, or in this case, the total return is another name for holding period return because you're holding it for 1 year. Holding period return will be 11.74. So this is how you can apply the interest rate forecast or incorporate your interest rate forecast to your bond strategy, right? We talked about this is already something we talked about. There are two types of yield, right? Yield to maturity and current yield. We already talked about, very in detail. Talked about these, so I'm not going to talk about it. We're going to skip. Now, here they have. I want to introduce. I want to introduce you to these two new features or functions in Excel, which is called, yield and price function. Rate, we already know. Yield and price function. So without further ado, let me just go ahead and do it. Because to find the bond price, we know how to do that. We did it, but we did it using the formula, right? And also finding the yield, the rate. We did it using the formula. But Excel has a built-in function called price and yield. So, but we need a specific, setup for that. So let me switch to Excel, right? Switch to Excel. Let's go to all right, so everyone can see this now, okay? The Excel. So here, let's move down to row 18, right? So in this example, this one is a little, this is a bit familiar setting, but also a little weird because this is the face value of the bond, and why is it $100? Why is it $100? I mean, isn't the face value of the bond 1,000? Yes, the face value of the bond is always $1,000, except the municipal bond, right? And then why is the payment only $2.75? Well, if the face value is 100, a 5.5% coupon rate, half your payment would be this. But look, this is not actually the dollar price. I just put dollar sign there, but this is the percentage, right? Remember, in bond quotes, right? On price quotes, it's the percentage of the always all the prices are expressed as percentage of the face value. So this means 100% of $1,000. Okay. 100% of 1,000. So this is actually $27.50 and so on, right? Now, in this setup, other than prices being expressed as percentage, what else do you notice? You also notice T0 and T. What does that mean? Well, of course, this is the now current. This is what maturity. Okay, we can in calendar dates, right? We can set this as today's date, right? So this bond has 5.5% coupon rate and 15 years to maturity, right? And the prevailing market rate is 6.5, right? So let's just change this to today's date. Today is for this video will be is pre-recorded, so bear with me. Today's date is actually the date I'm pre-recording this is the 18th. Okay, you will be watching this video on probably Monday or Tuesday. But it is Saturday, right? 18th. But when you do this exercise, you can put whatever the current date is. And I have built in, what is this? I did, because it's 15 years later, right? This plus E19 times 365, because it's calendar date every day, it's counting the time by days, right? And I'll show you later, how the calendar date is expressed in Excel. So then we need to go to functions, right? And then go to a financial category and scroll down until you find scroll down until you find price. Okay, hit OK, and then give it what it's asking for. Give it what it wants. Settlement, what does that mean? Settlement is the day, today's date. Settlement is when you settle the transaction. In other words, you buy this bond, right? Then that's the transaction, and you have to make the payment. You pay. That's when you settle the transaction, right? So settlement means when the transaction has happened. Maturity. This is the maturity, right? Give it. What is the rate? Rate means coupon rate, right? This rate means coupon rate. Okay. Yield. Yield means discount rate. Redemption means redemption date or maturity date. Frequency, semi-annual. This is important. That's why you have to, of course, all the bonds are semi-annual, right? That goes without saying. But you have to, without the frequency, first of all, I entered okay, so let's see, frequency, okay, and then hit enter. Something's not right. Okay, so let me retrace. Settlement date, maturity date, coupon rate, yield. Oh, I'm sorry, that was redemption value. And maturity date was already put in there, right? Redemption face value, okay? But it's still not correct. C9, redemption frequency. I go wrong. Settlement date, maturity date, and then coupon rate. G19 is redemption. Okay, let me try this again. Settlement, maturity, rate, coupon rate, yield, this one. Yield is the securities annual yield. And redemption is securities redemption value, right? Per 100. So redemption is, there you go. Frequency is okay, we got it already. I don't know why, what wasn't working. So we got the price. I don't know what was the matter last time, but I entered exactly the same variables, same inputs. So once again, this is percentage price, not the dollar price. So this means 90 90.51% of $1,000, 90.51%. So in dollars, that's going to be $905.10. Now here, yield, we can find yield when we know the future value and the current market price. So again, then we go to Excel's built-in function, scroll down to yield. Yeah, there is yield. Hit OK, and give it what it's asking for. Settlement. This is the settlement date. Maturity. This is the maturity date. Coupon rate. And then this is price, right? Current market price. Redemption. Okay. Frequency. There you go. I already gave you something here. Hit OK. 4.53%, right? So actually, this example, these are actually replicated example from replicated, same example replicated from above. Actually, look, it's this example. I solved it using rate, right? Or right? Rate function. I used it, and I entered price as negative, right? Because it's cash outflow. I got this. It's just because 2 times this, right? So, and this one is actually where did I have it? Oh, maybe I didn't. I used a. I didn't do this example using. I did. I just I'm using this file as in pristine state. In other words, we worked on this file last time in one of the last lectures, but I didn't save it. At the time, I definitely did this example somewhere up there, but not in this setting, right? But I didn't save it, so this file is in the starting all from the scratch. Anyway, so that's how you use yield function and price function, right? All right, so that's it for today. I'm gonna see you in the next video. Okay, next class. All right, end of video.